Welcome to GRE. I'm your host, Keith Weinhold. What control do you have over inflation and interest rates? Then, with the Florida housing oversupply and resultant attrition in price levels, wouldn't it be interesting to talk to a prominent Florida home builder? That's just what we do today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Coral, Illinois to Cape Coral, Florida, and across 188 nations worldwide, I'm Keith Weinhold, and you are inside for another wealth-building week. This is Get Rich Education, the voice of real estate investing since 2014. With inflation on the upswing, and is currently approaching 3% again, the formula is small down payment, bank buys you the house, tenants pay down the loan, property manager handles nearly everything, you collect cash every month, inflation builds you massive wealth, and that's real estate. All right, and no one really knows what's going to happen with inflation and interest rates, those two positively correlated indicators, but at times we have an illustrious guest that will make a prediction, and GRE episode 224 from January of 2019 has been getting some attention lately. That's back when interest rates of all types were really low, and when I interviewed legendary investor Jim Rogers in Singapore. Listen in to what he told you and I on that episode then.
You ask me, we're now headed up again, and interest rates are going to go much, much, much higher over the next few decades, and it's going to ruin a lot of people. I hope none of your listeners get ruined. I hope I don't get ruined, but rising interest rates are here for a long time, Keith. Be worried. Be careful.
Yeah, some real Jim Rogers prescience there in episode 224. He has seen some cycles. Now, as investors, we've got regional phenomena and national phenomena. Mortgage rates, they're a national one because more or less, whenever you finance property anywhere in the nation, your rate is going to be the same nationwide. Perhaps you feel then like you don't have any control over your mortgage rate. Well, I've got 2 points to that. First, understand that today, mortgage spreads are almost back to normal. Now, what does that mean? Mortgage spreads. From listening to the show, you probably know that the mortgage rate you pay is dictated more on the level of bond yields than it is the Fed funds rate that your own PAL controls. Well, 30-year mortgage rates are historically almost 2% above the bond yield, meaning they're 2% above the yield on the 10-year T-note. Okay, that's the bond yield. The spread was recently above 3%. Now it is down to about 2.5%. To be clear, mortgage rates are now just about 2.5% above bond yields. And this narrowing, that means there's more investor confidence in the mortgage market, and that suggests that lenders are willing to offer loans at competitive rates without succumbing to volatility. So lenders are less concerned about the risk of you quickly refinancing out of the loan that they just worked to make for you. The translation is that this opens the door to make it easier for mortgage rates to fall to 6%, and they've been nearly 7% for a while. Though I don't predict rates, I'm speaking about probabilities here. Some people want to lock up property before rates fall because when rates fall, many think home prices will surge because more people can afford property then, higher demand. And I think we all know that the conventional wisdom is to lock in your price now, and then if rates fall, you refinance. Conversely, if rates go higher, well, then you'll be glad you bought today when rates were lower. But today, we're talking about how you can really control the mortgage rate you pay when you work with a builder that won't only see that your mortgage rate gets bought down, they'll ensure that they are the ones paying for the buy down, not you. That's key. As we talked to a home builder in Florida today, a state that makes headlines for being overbuilt, it's a case study in how a market gets to an overbuilt condition, or does it really get overbuilt? It depends on the segment of the real estate market that you're focused on as an investor. As you'll see today, let's meet this week's guest. I'd like to welcome Jim onto the show today. He's one of the founding partners of a prominent Florida home builder. They've built over 9,000 residences and they have 120 plus full-time employees. And it's been such an interesting time in Florida home building and the real estate market. So that's why we're chatting today. Hey, Jim, welcome onto the show.
Keith, great to be back. Thanks for having me.
Let's talk about the problem. Statewide, Florida has about 26% more listings, more available housing inventory as compared to pre-pandemic levels. That's created some problems, some price attrition. Talk about why did Florida get overbuilt, or are they not truly overbuilt when we segment that by product type?
Well, like you said, Keith, product type is really important to decipher here because it does help dissect the problem a little more clearly. There's a lot of different markets happening, but two of the main things that I've seen that have caused the softening of certain segments of the market is one, insurance. If you are buying a 1957 home in Southwest Florida, a few blocks from the beach, it is possible that your insurance has gone up 4 to 5 times. Yeah, the annual thing. So that is going to really start to shake people who own those properties. They're going to feel a little triggered to sell. And it's going to be more difficult to sell because if you have an agent go and show that property and they ask for a good faith estimate from a lender and they say, well, what's your current insurance? That can really scare people. So that type of property, normally properties older, before 2004 when the rules changed, with higher insurance, that can change it. The second thing is the emotional market always seems to take a hit, Keith. And I've heard you talk about this before. Now, the emotional market that I talk about is we have our median value in any of the real estate markets, right? And you go about 25% above the median, maybe 30% above the median values. That's what I call the emotional market. These are the really nice houses that are fun to visit, nice to stay in, nice to live in, but they are emotional. This is an emotional market. The cash flow numbers have never worked. They're not on the ultra high end that those people normally own cash and they don't really care the fluctuation. It's that level above the median where I see the emotional market really take the hit, because when the emotion comes out, well, the people, it's harder to sell, to find the buyers, especially with the rates jumping the way that they have over the last 2 years. There's not the ability to sit back and say, well, you know what, Keith, I'm just going to hold this and rent it, because their negative position, their negative cash flow every month begins to sink them quickly. And so that's where you see that pressure downward on that emotional market, if that makes any sense.
Did Florida really get ahead of itself with the increase in pandemic migration? Was there more building because they projected that high migration rate to continue and it just didn't? Is that why areas of Florida are overbuilt?
What I believe happened was the migration was there, Keith. But again, you have to look at the sectors of the market. Now, when you're looking at a large national home builder, their goal is to sell the property with the greatest profit spread. It's just that simple. And those are the properties when times are good and times are hot. This emotional market, 20, 30% above the median value for an area. That's a very easy time to promote and to sell those types of properties and make the best spread for them. And so, yes, in that area, they got ahead of themselves because it was easy to market to, easy to promote to. And again, Some people, untrained investors or people just emotional and saying, well, I'm going to have a second home in Florida and I'll get there more often than I think I will. That causes that issue. Now, but going to the lower segment, like the workforce housing, like you and I have talked about, well, that has been underprepared for the migration. And affordability, that is my word of the year, affordability. The
Sure.
affordable housing, the workforce housing, when you look at the stats, I think it was last year we found the stat that for every 25 workforce housing, new construction workforce housing, there's 100 renters. And so the workforce housing has been underdeveloped. And why? We're a niche builder. It's very rare for a builder like us to focus on workforce housing. That's not the focus of many of the larger builders. They're on that more emotional market. So that's where we focus. But with builders like us focusing on that and no one else, that part of the market, Keith, has been undersupplied actually in the last few years because the net migration didn't need those emotional houses. They needed the workforce housing.
This is a great distinction. We can look at a stat like there's 26% more available housing inventory in Florida statewide than there was pre-pandemic, but you've got to parse that by product type. Workforce housing, which you specialize in, including build to rent housing, has not been oversupplied, not nearly to that same extent. It could even be undersupplied depending on where you're at. These are the properties that make the best long-term income properties. I hope you, the listener, caught it there. Jim gave an important date. 2004 is a key year when there were changes to building codes, which results in what your insurance premiums are going to be. Tell us more about that.
Yeah, 2004, right through Punta Gorda, Florida, where we build now. When there was Hurricane Charlie came through. My dad's cousin actually lived there at the time. I mean, that place got decimated, Keith. It got absolutely decimated. And the government called timeout. They said, timeout. Okay, we got to stop this. New rules. Moving forward, we're going to change the structural design requirements. We're going to change the elevation requirements. This is the big one. So, back in the day, you and I, if we were back in 1962 in Fort Myers, Florida, we could build a house at 2 feet or 3 feet above sea level. Those days are gone. If you're going to build a property like going back to Punta Gorda now, today, you have to build it at 13 to 14 feet above sea level. So that means builders like us got to bring in a lot of dirt. And we grumble and complain about it until a storm goes through and we have no flooding on any of our properties. But that was a requirement. Then stronger fasteners and structural design because they just didn't want that risk or this type of damage. And it's been interesting because there have been 2 hurricanes, since 2004 that have really gone right over the main power of the storm has gone through Punta Gorda. I've actually showed this on some videos that we've done on YouTube, like the flyover the next day. And you would think, oh, well, maybe there was like a strong wind that went through because there's palm fronds down and some fencing, but the houses are intact. And it's because things had to be rebuilt to today's standards. So I always tell people, hey, we'd love to help you get a house, but if you're just going down there to find a house, I would highly recommend you look at the elevation and look if your house was built before the year 2004 or after, because that is really when things started to change. Not that a house earlier might not have what you're looking for, but elevation is such a key component when you're near coastal areas in Florida, the elevation of your home.
Is it that simple? Pre-2004, you're likely to pay substantially higher insurance premiums on your Florida property than you are if the build year was 2004 or later.
It's a main component, Keith. Another component will be to that is, how close are you to the beach? If you're within, a half a mile of the beach, that can have, and on lower ground of an older property, those combinations for risk analysis for an insurance company will come up not in your favor. And so you have to put that into account too. Again, the further you move inland, especially the further you move north and the further you move inland in Florida, the insurance premiums go down because the risk assessment of the last 100 years of hurricanes has been so much dramatically lower of actually causing issue.
We'll talk about the Florida areas that you build in later, but first, let's just pull back, talk about statewide. How bad is it? How bad is it with the overbuilt condition in some segments of the residential market and how that's led to price attrition, a lack of rent growth, or rental occupancy rates that are hurt potentially? Can you speak to that? How bad is it now?
Again, going to the segment of the emotional market. So we're talking 20 to 30% above the median price in an area. That's going to be bad. That's where you're going to have downward pressure. You're going to have to, your property may have appreciated well if you did in 2020, but you're not selling at peak pricing. You're going to have to come off your numbers a good amount because there's not as many buyers. And also you got to remember, coupled with that pricing coming down, it's also the interest rates. We got pretty spoiled, 3.5% interest rates, 2.5% interest rates for some homeowners. That's just not the norm now. So when you're going off those numbers, the affordability, the ability to make that payment has really been affected. So that emotional market, I think we're going to see a continued softening in that. And again, in that emotional market too, what I saw was, and I own some short-term rentals and I like short-term rentals, but what we saw, there was a rush, like almost like a California gold rush here in Florida, to people coming in and buying what they consider a short-term rental, which was not really desirable for short-term rent. It could get a few people here and there, but they would buy at this emotional market and then the numbers wouldn't work out. Now that as well is starting to put pressure on people saying, oh, I'm losing so much money every month, let's just sell. And again, that emotional market, that area 20, 25%, 30% above median value, that's where we're seeing that. So you're going to see some pressure downward of that. I'd say at least another 10%, because there's already been a dip in some areas, 15 to 20%. So there has been a correction in those. And I think we'll continue to see that until some of this stabilizes.
Talk to us about how the rental segment's doing statewide.
Rental, we saw a stagnation for about a year and a half to 2 years. And just in the last 6 months, we've seen an increase in some of our main markets here. Again, when I say main markets here, I'm always speaking, because that's what we stick to, the workforce housing. So we've seen workforce housing in some of our main Central Florida markets and some of our Northeast markets go up another $50 to $100, which was great because it was stagnant for about 2 years. And then you'll see a continued dip of probably, 10 to 15% on some of that emotional market rentals, because now there's a rush to try to rent them. And again, there's not as much of a demand for that segment of the market.
We're talking with a prominent Florida home builder about Florida's temporarily overbuilt residential housing type. We've already learned that 2004 is a key year for what your insurance rates are likely going to be. We've also learned about how you need to segment these residential housing markets between workforce housing and the emotional side of the market. You're listening to Get Rich Education. More when we come back on Florida Real Estate. I'm your host, Keith Weinhold. The same place where I get my own mortgage loans is where you can get yours, Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com. You know what's crazy? Your bank is getting rich off of you. The average savings account pays less than 1%. It's like laughable. Meanwhile, if your money isn't making at least 4%, you're losing to inflation. That's why I started putting my own money into the FFI Liquidity Fund. It's super simple. Your cash can pull in up to 8% returns and it compounds. It's not some high-risk gamble like digital or AI stock trading. It's pretty low risk because they've got a 10-plus year track record of paying investors on time, in full, every time. I mean, I wouldn't be talking about it if I wasn't invested myself. You can invest as little as $25K, and you keep earning until you decide you want your money back. No weird lockups or anything like that. So if you're like me and tired of your liquid funds just sitting there doing nothing, check it out. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund. Again, text FAMILY to 66866.
This is author Kristen Tate. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. Jim is with us, a prominent Florida home builder, and it's so interesting to talk to a home builder today because you think of Florida as overbuilding ground zero, even though paradoxically, nationally, we're still in a somewhat underbuilt condition where there's somewhat of a lack of available housing supply. Now, back on our April 28th show, exactly 3 months ago today, which I know that you listened to, Jim, that show was titled, Is Florida Real Estate Doomed? And the short answer is no. And I gave a number of reasons for that. You don't want to catch a falling knife as an investor. One prominent reason that Florida real estate is not doomed, and you're not catching a falling knife, and this is so close to being 100% predictable, is the fact that the growth is going to be there. It always has been in Florida. The in-migration has been remarkable. If you go back and look at every census over about the last 200 years since 1830, Florida has grown substantially every single census, oftentimes and usually at a rate greater than the national average. So in-migration is almost certainly going to continue, which over the long term will put upward pressure on prices, upward pressure on rents, and help with rental occupancy as well. When you have a vacancy, that next incoming tenant is going to be there. I think that's about as close to predictable as it can possibly get. So talk to us more about the dynamics in Florida and the in-migration.
It's funny, Keith, last year, the net migration, and you can check through all the stats out there, the net migration number for Florida, that means more people obviously coming in than leaving, and the surplus was just about 470,000. So we still have a growth of 470,000, and people have said, oh, Florida net migration is over. And I'm going, well, it was pretty superb during the pandemic, but to say it's over when it's about 500,000 up from last year,
Wow.
I think would be a misconception for at the very least. So we feel the people are still coming, and we're asking, what kind of housing do they need? Do they need that higher end emotional market housing? Not what we're seeing. What they're needing is affordability. They're going to areas where there's still great job source, there's still great affordability. And that's what we look for. Where can we still build a new construction single family home for under $300,000 and have great job source close by? That's one of the things that we look for. Also, where is there that undersupply of that workforce housing? There are very key markets in Florida that you know about that we build in. We're saying, yeah, there's lots of stuff on the market up there, but there is no supply of this workforce housing. We're going to keep building. And as you know, we have not stopped building the last 2 years when a lot of people have run for the sidelines because they weren't in our sector of the market.
Of course, you're very strategic about where you build. Geographically, talk to us about where those places are.
Right now, Keith, my pick of the year has been the greater Ocala region. And I know we've been working with a lot of GRE folks in that region. A couple of reasons why. Still had the strongest migration of any area in the U.S., and you can look that up. U-Haul had it as #1 destination place. This was, when I say greater Ocala, I look at Ocala, Citrus Springs, Inverness, that central Florida area. Still in some of those markets, Keith, we're building homes for 260s, 270,000s. That's new construction and enabled to get great rents and great financing, which we'll talk about. And the job source is remarkable right now. In fact, interesting statistic, Keith. I know you watch this closely. In Ocala, the median price of a home is just around 300,000, main Ocala. You can get cheaper when you go out to Citrus Springs and Inverness, down to the 260s, 270s. But the median family income is 72,000. And when you look at that, that is a very good affordability index. That's a very high average family income compared to a low median price. And that's bringing in more jobs. That's bringing in more security. Couple that with Central Florida being one of the lowest hurricane risk zones in the state. It's the highest ground. It's the furthest inland. In fact, to insure a single family home on average in that area, about $65 a month for full coverage.
Wow.
For a duplex, $105 a month. Full coverage. And that's the advantage of new construction, buying in the right areas or low hurricane risk zone, and great job source coming in. So my favorite market right now, Keith, is that Central Florida Ocala, Citrus Springs, Inverness. That's where we're building. That's also when people say it's overbuilt. Well, no, because we know that we're actually building for a few of the big institutions that have way bigger analysis departments than we do. And they're seeing that it's so behind on housing that people are finally going in. It was kind of an overlooked market all through the pandemic for the most part. And now it's finally getting people's attention.
A couple months ago on the show, I shared how a close friend purchased a new build Ocala duplex through you.
Mm-hmm.
The rents he got were even a little higher than you projected, and his insurance premium is $694. Again, this is for a duplex. I forget, I think the purchase price was $400 to $420K on this new build property.
Yeah. And it's funny when we have lots of investors coming from all over, but I was in California, as you know, for years. And when people hear a quote like that you just said, $656, they think that's for the month. And I say, no, that's for the year. And again, that's the misconception. Now, but you could pick up and you could go to a coastal area. Again, like I said, in a 1952 duplex built at 2 feet above sea level that's had hurricane issues before, and your insurance could be $8,000 a year.
Yeah.
But that's where you have to really shop before you actually pull the trigger on a property. What are the taxes? What are the insurance? I mean, this is going back to core play, core strategy, but it's something you really have to look at.
Talk to us about the product types that you're offering. All new build and what percent of single family duplexes and larger?
The main majority of what we're building right now is single family and duplex. The numbers work great. They're in high demand. You know, duplexes are a pretty interesting product, Keith, because you can put them in single family home neighborhoods. And, you know, families that couldn't normally afford to rent a full house there can avoid an apartment building, still feel like they have their own home and afford to be in that neighborhood. So I'd say 80% of what we're doing is a combination of single family home and duplexes. And then, as you know, we still are building some of our quads, our 4-unit buildings in some areas of Northeast Florida, like Jacksonville.
Expenses have obviously been on the mind of real estate investors, more so since interest rates doubled to tripled in 2022. You're selling to investors. Investors need the numbers to work since they're not in the emotional market. We're in the market where we're looking at numbers. And that biggest expense, of course, is your mortgage principal and interest. So you found a way to deal with high insurance premiums because on most or all of your properties that you sell to investors, those insurance premiums are excessively low. Talk to us about what you've done with the mortgage rates for investors.
It's such an important point here, Keith. I remember hearing a Warren Buffett thing years ago saying, well, I'm not really in the real estate and that, but for me, when I look at it, a house is worth what it can rent for. And that always stuck with me, being Warren Buffett, even though he's not heavily invested in real estate like we are, but get his sage advice on that. That's always stuck with me. So when you're getting a property, yes, you want to have fair price, but the terms around it that actually produce the cash flow are what's the condition of the property? Where is it? But then the other fundamental numbers, what is your insurance? What are your taxes? And then the final big thing is if you're leveraging, which I encourage, what's your mortgage? And so, as you know, we're probably as obsessed with financing as we are with building right, because that's our model. We got to build right. We got to finance right. So we're always looking for the most advantageous programs where we can team up with banks. They'll allow us to pay an abnormal amount of points, which means discount points that we will pay, not the buyer. We will pay for our buyers to get the rate the lowest and most advantageous. We don't like short-term teaser loans where your rate's going to adjust in 18 months or 2 years. We saw a lot of people get in trouble with that. At least I did back in the 07, 08 days. So we want long-term financing and low interest that's going to produce a cash flow, even though it's new construction from day one. And so right now, our newest program, as you and I have been talking about, very excited, is actually a 40-year loan. It's a 40-year loan. We're paying the rate down. Right now, we're at 5.25. A few weeks ago, it was at 4.75. So it does fluctuate back and forth. But here's what's exciting, Keith. You're leveraging into a new construction property that has longevity and durability. The first 10 years, interest only. The next 30 years is a 30-year AM, 30-year fixed at 5.25. So when you start to do the numbers and go through it, we're almost doubling cash flow on our single family homes and duplexes for people in areas like Ocala. And that makes such a difference to getting them off on the right foot.
This is a key distinction. Rather than focusing on slashing the price and your properties are already affordable, you buy down that rate by purchasing discount points to buy down that mortgage rate for the investor at the terms that you just described. Builders often like this more. They don't want to cut their prices because that can become a comparable and lead to a downdrain in values. And investors actually like it more as well, because rather than discounting the price a little more, it helps the investor more when you buy down that rate and you do it for them. They are not the ones participating in the rate buy down. You, the investor, you're paying the closing costs like origination fee and title insurance and things like that. Okay, with those 40-year loan terms like you laid out, fixed interest only for the first 10 years, and then after 10 years, it transfers to a 30-year fixed amortizing loan, still with that same rate locked in. Is that right?
That's correct. So sometimes people think, oh, then it's going to trigger upwards several percent. It stays the same the whole 40-year term. We just go from interest only to principal and interest. And again, because you talk about the leverage all the time, the most important time to really solidify the strength of an investment and get cash flow going, the most pivotal time is in those first few years.
Yeah.
We feel we're really giving people that strong foundation to get it cash flowing right off the bat and be able to look long term. The great thing about new construction is people say, could you hold it that long? I said, I'm planning to with some of my new constructions. Hopefully I'll be a little old man or my children will own them. But you can look out that far and know that you're jumping your cash flow in those initial years when a lot of people may be falling backwards. In fact, when we talked about those emotional markets where people bought higher end properties because they looked good and they felt good to walk through, and then all of a sudden they're bleeding month in, month out for a year, 2 years, 3 years, that's when they're ready to wave the white flag. We find with our model, with getting that rate really low, we're accentuating the cash flow forward those first few years, Keith, so they're ready to keep going after a few years instead of raise the white flag.
Yeah, when we think about how you're helping investors here while moving product at the same time, the number of problems that are solved are remarkable because you're solving the higher mortgage rate problem by buying down the rates. You've got a low rate. You've got a low insurance premium. You as the investor are almost certainly going to have low maintenance and repair costs since it's new build. And what else do you do when it's new build? The tenant, when they move in, they're the first person that's ever lived in that property, which probably means they're going to have a longer tenancy duration because it's hard to move up and move into something better than the product you're offering, especially with low affordability for first-time homebuyers. In fact, tell us about your average tenancy duration.
Yeah, so as you know, Keith, I did a ton of fixer-uppers. First 15 years of my career, I wore that rehab badge on my shoulder with pride. I loved rehabbing old houses. And look, that's great. And that's a great way to get going. But I transitioned into new construction a decade ago. And so we've been able to do a lot of comparisons. And, back in the day when I was fixing up lots of properties and renting them out, the older properties, my average tenant would stay about 13 months. It was a little over a year. Get them for a year and then they was moved. But that was the average, 13 months. Looking back now, and we've been doing this almost a decade, when you look at our new construction model, that went from an average of about 13 months to just over 3 years with our new construction product. So as you know, if all of a sudden we're pushing back that first move out from a year or 13 months to over 3 years, that's a tremendous way, again, to get the right footing and directional on your investment. So that was a really pleasant surprise. I did not expect going to new construction, but jumping from a year to 3 years has been a nice surprise.
This brings to mind for you as a passive investor, it's sort of analogous to buying an existing business or starting a new one from scratch yourself, whether it's a rental car company or a tomato farm. A lot of people, when they think about getting into business, they think about buying their own business, starting it from scratch, and that's really difficult to do. When you're an investor this way, you're not doing a fix and flip yourself, which is analogous to starting your own business from scratch. You get to buy someone's existing business. You're buying an existing property, a new build one in this case, and that way you can look at all the financials already and have it be done for you in that all done for you sort of way, just like it is here. Well, Jim, do you have any last thoughts about the Florida real estate market today, especially with the lucrative product type that you're offering to investors?
I would just remind people, do your homework because there's apples and there's oranges and you got to compare the two. And you have to do the homework on which segment of the market is healthy and which one is not. I wouldn't recommend you invest in the unhealthy segment of the market. but look where the fundamentals are working and go back to that term. A house is worth what it can rent for. And if you can look at that and also couple it with stability of new construction, this is where we've seen ourselves make the most money, most success with the least amount of time for our investors. So I highly encourage that recipe for anyone out there.
In addition to being a builder, Jim's company also holds properties under management for investors just like you. They offer that for you for the long term. They have over 1,000 current investors. Many of them are GRE listeners. You can learn more about the provider at GRE Marketplace under Florida statewide. But to get a free strategy session about the latest in what they have for available inventory, and also to compare this provider to other providers, the highest flex, the highest ROI move that you can make yourself as the listener for your due diligence is to connect with a GRE investment coach. It's free at greinvestmentcoach.com. Oh, it's been valuable, Jim. Thanks for coming onto the show.
Thanks for having me, Keith.
Oh, yeah, hearing it straight from a builder today. And a lot of builders create these nice looking, emotional type homes, the same ones that appeal to owner occupants. They build those higher end homes because they create more builder profit. Well, that's the segment that has become overbuilt today. This build to rent provider we're talking about here is dealing with a public that reads these articles about the Florida slowdown. Though things are still good in this workforce housing market, well, because the public reads headlines, this builder still has to step in with incentives. So really, this is a case study on what a home builder needs to do to adjust to public perception more so than the reality. That's why Jim and his company keep building when others aren't. They keep building because they keep selling to savvy investors, including you, the GRE listener. Conversely, the overbuilt emotional market segment, that's where Florida single-family home prices are often about $500K or more, and many of them have stopped building. Instead, here with this workforce housing, brand new single-family rentals sell for the high $200K to $300K range in the 300s, and duplexes in the 400s. We've been working with this provider for nearly a decade, and I've asked them, what can you do for GRE listeners? And these are the best incentives yet, as they basically are making discounts in your favor to deal with this public perception. And they are an interest rate buy down that they make for you, like we mentioned, currently to 5.25%. They're also giving GRE listeners 2 years of free property management, a rental protection program, a 6-month eviction guarantee, and a 2-10 builder warranty. When you see a builder warranty expressed that way, that means they cover 2 years on the small stuff, 10 years on the big stuff. The latest pro forma that I saw for their single-family rentals had a purchase price of $325K and a cash-on-cash return of nearly 7% when you include all those generous incentives. So if you're looking for a new market to expand into, the time and place could very well be here and now. Some people wait for blue sky and everything to be perfect before they act. Well, that never happens. This is about as close as you'll get. Today, you'll either keep what you've got or change what you're doing. Here at GRE, we constantly shop the nation for you. Our coaches help show you where those deals are that they found, and this is a potential opportunity here. You can get on the calendar of one of our investment coaches for free, and if you like, start by asking about Florida new build property with all the incentives that you heard about here on GRE Podcast 564 at greinvestmentcoach.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Whenever you want the best written real estate and finance info, oh, geez, today's experience limits your free articles access, and it's got paywalls and pop-ups and push notifications and cookies disclaimers. It's not so great. So then it's vital to place nice, clean, free content into your hands that adds no hype value to your life. That's why this is the golden age of quality newsletters, and I write every word of ours myself. It's got a dash of humor, and it's to the point because even the word abbreviation is too long. My letter usually takes less than 3 minutes to read, and when you start the letter, you also get my 1-hour fast real estate video course. It's all completely free. It's called the Don't Quit Your Daydream letter. It wires your mind for wealth, and it couldn't be easier for you to get it right now. Just text GRE to 66866. While it's on your mind, take a moment to do it right now. Text GRE to 66866. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.